Hello, folks. Welcome to another SACPA session. SACPA acknowledges that this event takes place on the lands of the Blackfoot people and the Métis Nation of Alberta Region 3, and we pay respect to their past, present, and future cultural heritage, beliefs, and relationships to the land. SACPA is very thankful for the continuing support that we receive from both the University of Lethbridge, Shaw Spotlight, and the Lethbridge Herald. We're very happy to have with us today Jeffrey Hodgson. Thank you for joining us, Jeffrey. Jeffrey joined the CPP Investments in July 2017. He oversees the global stakeholder affairs function. Jeffrey has more than 20 years of experience as a financial journalist on 3 continents. He began his career at Bloomberg News in Toronto and subsequently took on a variety of reporting and editing roles at Reuters. These include postings in London and Hong Kong, where he led coverage of Asia's asset management industry. More recently, he was the business editor for the Canadian Press, overseeing the works of journalists in Toronto, Ottawa, Montreal, Calgary, and Vancouver. Originally from Saskatchewan, Jeffrey holds a Bachelor's of Journalism degree from Carleton University in Toronto. Thank you very much for your time and for joining us today, and we very much look forward to your presentation.
Okay, Annalise, thank you very much. Well, I want to start by saying thank you so much to the organization for taking the time to host us and allow us to sort of talk to you today. The SACPA, it's amazing when I sort of learned about the organization that you have more than a 50-year history of doing this. I myself, originally from rural Saskatchewan, my parents' farm grew up near Prince Albert, and I know just how much an organization like this that sort of encourages a discussion of public affairs in the community, the real power and the real benefit that can have. So again, it's a real privilege for us to be part of that. I'm going to talk to you today, give you an overall introduction to CPP Investments. I'm going to start by talking about the Canada Pension Plan itself, and then move through to CPP Investments, the organization that I work for, what we do, what our function is. So I'm going to move to slide 2. So again, just the run of show today will be the introduction to the CPP, talking a bit about its sustainability, the CPP investments, the investment engine of the plan itself, which is the organization I work for, our investment strategy and performance. So starting off at on slide 3, some of you are seeing some very lovely multicolored sort of pillars here. I just want to give some context about where we fit within basically Canada's retirement system. So when people talk about a retirement system, the retirement system in this country, they're generally referred to sort of 4 main pillars. The first one of the first ones being workplace savings for those individuals who are fortunate enough to work for an organization that provides either a defined benefit plan or defined contribution, group RRSPs, this sort of thing. And this is where you can have, can be funded by employees or employers to sort of build up that key component of your retirement plan. There's of course private savings. Again, people are fortunate to be able to save in RRSPs, TFSAs, bank accounts, all funded by individuals out of their after-tax earnings. Old age security and the guaranteed income supplement, the third pillar, which is in terms of the government orchestrated, is the oldest, going back many decades when it was first introduced in the early 20th century. As you know, what it's evolved to now, it's a fully taxpayer-funded program, means tested, and again, it'll ultimately reliant on the in terms of federal tax revenues to support that. And then the fourth pillar is the Canada Pension Plan, which is a different entity. It is funded by the contributions from employers and employees, and it is not taxpayer funded. It is separately sort of ring fenced from general revenue, and again, there employers and employees, unless they're self-employment or are the ones paying the contributions into the plan. I'd like to move to slide 4 to give a little bit of a timeline here and to go back to the creation of the Canada Pension Plan itself. So in the 1960s, there had already been, the equivalent of old age security for at least some time, a couple of decades, and that had evolved in terms of its applicability and the breadth. But there was still an issue with, frankly, poverty in retirement. A lot of Canadians still didn't have the means or resources to sort of ensure their own retirement. So governments banded together, and an important consideration here to remember is that constitutionally pensions are sort of fall under the remit of the provinces. So when the Canada Pension Plan came into being, what had to happen was there had to be the federal government had to sit down with the provinces and come to sort of a cooperative sort of federalist model. Now at that point, Quebec decided that they would have from the initiation their own separate plan, and the other nine Canadian provinces came together to create the Canada Pension Plan, initiated in January 1966. Now, if you look down a little bit under the chart, you'll see this lovely little diagram of what depicts 6.5 workers. And we put that there to illustrate something about the early Canada Pension Plan. It's what was called a term I hadn't heard till I became employed here, a pay-go system. What a pay-go system means is that for every, basically, you simply have, 6.5 workers, you deduct their contributions off of their paycheck, and you give it to one retiree. And you can have a system if the demographics are supportive of that, that can work very well for the period of time in which it's sustained by the demographics. But as you'll move along here, you'll see a few things. And interestingly, one thing we flag when we do this presentation is 1969 birth control pill legalized in Canada. And through the 70s and 80s, you had some changes in demographics. You had lower birth rates and you had increased life expectancy. So it basically changed that dynamic of, 6.5 workers supporting one retiree. People are, fewer younger people being born and people are living longer. Now, every 3 years to this day, there's an entity in Ottawa. It's an independent agency called the Office of the Chief Actuary. It's within Ottawa, and one of its roles is to basically do a 3-year checkup on the Canada Pension Plan to sort of make sure that it's sustainable, to see how it's working out. Now, in 1995, they went to those 10 governments, the 9 provinces and the federal government, with some very bad news. And they said, demographics are shifting and the existing pay-go model at these existing rates is just not sustainable. Now, there was a fund there to support the Canada Pension Plan at that point, largely in, I believe, provincial debentures. And the chief actuary said, look, if nothing changes, if you don't change any conditions, by the year 2015, the funds that are supporting this will be depleted. You're either going to have to significantly slash benefits or hike contributions, and effectively over to you. Because the Office of the Chief Actuary's job is to assess and provide the governments with that assessment. So, and what I think is a heartening example of cooperation, you had governments, 10 different governments, different political parties, all kind of sitting down to try and agree on how to solve the problem, and they initiated the CPP reforms. And the key point that I want to sort of highlight that came out of that was the creation of the Canada Pension Plan Investment Board, which is our legal name, also we're known as CPP Investments. And we were created with, and the decision was made that excess contributions at that point would begin flowing into CPP Investments to invest at market rates. So these higher returns that would be generated by the investments would help to sustain the plan. And it worked. It's very fortunate. I'll be talking more about this as we go along. But ultimately, subsequent to that, when we've done the triennial reviews by the Office of the Chief Actuary, they have found the Canada Pension Plan to be sustainable for the next 75 years. So that is a very heartening development. And it's one of these things. It's maybe good news that you don't hear so much about, because there was a crisis. It was a long-term crisis in the works. It was addressed and moved on from there. A few other things we'll talk about is a move to active management that was made for CPP Investments in 2006, and also a little bit about the enhancement of the Canada Pension Plan in the last few years, a decision made by governments to do that. But we'll go to there. Moving on to the slide 5. So just to tell everyone a little bit, many of you are familiar. Some of you may be recipients of CPP at this point. Many of you working maybe contributors. So the current plan, as it was set up before it was expanded, sort of maximum pensionable earnings of 64,000. So basically, it's collected on that amount, and that amount was increased. And the reason CPP was expanded, it was a goal of when it was originally set up. the CPP was designed to deliver about a quarter of the average industrial wage. So an important point to remember is that CPP was never meant to be everybody's entire retirement. That's not the design of the plan. It was meant to be one of the pillars of the retirement that could sort of interplay and support the others. And the expansion of the plan, the design has gone to go from like 25%, I believe it's average industrial wage, to 1/3. So to give some sort of illustrative examples of that, for under a previous plan for the average worker earning about 55,000 a year, they could see CP payments of 15,000. Now for that same worker under an expanded plan working the prolonged amount of time, you're looking at more of an income of 17,000. For a higher income worker, it could be more closer to 20,000. So that's been the change that has to facilitate that. Contribution rates by both employers and employees were increased under this expansion plan, and that's being implemented and rolled out. So moving to slide 6. Now, CPP fund benefits, what is paid out under the Canada Pension Plan? I think probably most of us are aware that CPP is there for when we retire. Many people, the target is 65. You get, you begin to collect CPP. But the benefit, there's flexibility around it. For those who are at least 60, you can apply for it. However, there's a penalty in terms of what you receive. Likewise, if you can delay it to, I believe, 69, but there's actually an additional benefit that is paid out when that happens. But the Canada Pension Plan, it's not just that. Some people may also be familiar with the fact that it can pay out disability pensions. And if you move to the next slide, you can also see there's a survivor's benefit that can be paid out, and also a one-time lump sum death benefit that gets paid out to the estate of a CPP contributor. So these are just a number of the benefits that are paid out under the plan, and requires us to sort of invest the funds to support that. And to sort of give a final sort of overview of the plan, at this point, this slide may even be close to dated because it's over 20 million Canadians participate in the plan. I think if we haven't crossed up of over, we're going to be coming up on 21 million contributors and beneficiaries, and that is more than 2.5 million Albertans are part of the plan. Now, going back again, I'd like to talk about sustainability. So we'll jump ahead to maybe slide 10, where again, I just want to reiterate that last piece of the puzzle that I was talking about, where on the timeline of the earlier slide, that the CPP fund, we are assessed every 3 years for sustainability by the Independent Office of the Chief Actuary. Again, the most recent report indicated we're expected to meet our obligations for at least the next 75 years. I'm going to show a couple of slides that illustrate that more, but one of the reasons I'm much appreciate the opportunity to speak with you today is to talk about that CPP sustainability, because and when I can be back home in Saskatchewan, family gatherings and this sort of thing, and talking to people, maybe younger people, nieces, nephews, cousins, etc., and they might be like, "Oh, CPP, well, that's not going to be there for me when I retire." And this is what kicks me into the mode of trying to share the facts that we have, which is one thing, and though we want to examine why is that, and how widespread is that? Well, our organization has done some polling over the years to just sort of have a sense and understanding of how much Canadians know about Canada Pension Plan and CPP investments. And what we've consistently found is a majority of Canadians either don't know or don't believe that the CPP will be there for them, which is pretty surprising. And when I talk to financial advisors and people who understand, they're they sometimes taken a little bit aback by when we were able to share those numbers. And we've talked a little bit. We have some theories about why that is. Now, one consideration is if you're of a certain age, my age specifically, you might remember the 1990s and when this whole public policy debate was unfolding, and we had a situation in which there were headlines saying the Canada Pension Plan is not sustainable. It won't be there for you. And that was with good reason. It was because at that point it was not sustainable. It was set up to sort of run out of those funds at 2015. I think that's resided in a lot of the collective memory. Another factor to consider is that if you look at the situation with U.S. Social Security, the U.S. Treasury every year has to come out with a situation talking about the Social Security Trust Fund, and they regularly announce every year that unfortunately, unless action is taken by governments, that fund will be depleted by the mid 2030s. So again, you've got a situation in which there's that question mark around Social Security and the depletion of that fund. That doesn't apply to Canada. It's totally different systems. So I think that feeds a lot into perceptions. But and I think the third piece is sometimes we've got situations with companies. Unfortunately, we've seen where companies have slipped into bankruptcy, and pensioners have ended up not getting their company pensions, and that I think that creates a lot of insecurity as well. So this is why we're very pleased to sort of talk to people and say, well, in the case of the Canada Pension Plan, the sustainability is, sort of look to the Office of the Chief Actuary and their studies and what they say about the durability. Just another couple quick slides. Slide 11, there's a 2050 projection about the CPP fund that underpins and supports the Canada Pension Plan. We've crossed over $500 billion now, and based on some actual projections, it looks like we may be approximately a $3 trillion fund by 2050 as we continue to receive assets and invest those assets for higher returns. And slide 12 with just a bit of an illustration with the fund at 540 or 550.4 billion at the end of the last calendar year. That's well ahead of projections of where it was initially expected to be, showing that there's that buffer of protection as we go forward. Now, moving on to CPP Investments, the organization that I work for. Now, if you, again, lots of times be talking to family and folks, and they're like, "Oh, you work for CPP? You're in Ottawa." And I said, I have to explain. There's a difference. The Canada Pension Plan, again, it's a federal provincial sort of model. So it's overseen by the 10 governments. Administration comes out of Ottawa Government Department, who will actually send you your CPP checks. But in terms of CPP Investments, I explain we're actually the investment engine of the plan. So this fund that underpins the Canada Pension Plan is invested by us. We've headquartered in Toronto, and our sole mission is to focus on that investment piece. So that's what we're here to do, to deliver the returns that sustain the fund. And moving to slide 14, our purpose, provide the foundation upon which 20 million Canadians can build their financial security in retirement. Now, going a little bit into the mechanics in slide 15, you should see one with some green and purple and blue boxes in there. So again, we have the situation: contributors, sort of working Canadians and their employers paying into the plan, flows to the Canada Pension Plan Fund. Those contributions are then invested by us in global markets aimed at generating the investment returns needed to sustain the fund. Those are taken back and will ultimately flow in to benefit payments, which go back to beneficiaries when they are set to receive those funds. I'd like to talk a bit about the structure. Slide 16, you'll see a gold standard for national pension plans. We have staff at CPP Investments. We've hired, many Canadians, people from outside of Canada, global financial professionals. And it's interesting. It's often sometimes the people outside of Canada who talk about and flag the fact that the model of the Canada CPP Investments, the Canada Pension Plan Investment Board, sort of internationally recognized in terms of its governance. Because while we're set up as a federal crown with this oversight of our stewards, the 10 governments, we operate at arm's length from government with an independent professional board of directors. And that is very key and critical to sort of in terms of us succeeding on our mission, because people could, I talk to Canadians and they'll sometimes say, "Oh, well, wouldn't this government or that government tell you how or where to invest?" And I can say no, because of the structure of the plan is very clear. We operate, at arm's length with an independent professional board of directors. That board selects our CEO and approves our investment policies. So the investment decisions are made by investment professionals in alignment with the objectives set out for us. In terms of accountability, we have extensive disclosure. Many major global, pension fund managers like ourselves will report results once a year. We report 4 times a year. We have annual audits, a triennial review of the Canada of CPP Investments, and or the Canada Pension Plan by the Office of the Chief Actuary. It's also special audit provisions, and importantly, public meetings written right into our legislation. Is that every 2 years in each province that is a member of the Canada Pension Plan, we have to have a public meeting to where we go, we present on our results, what we're doing, and also hear from Canadians. Now, moving on to slide 17. If some of you are real legal fans and they're out there, my wife's a lawyer, she's very enthused about things legal. You can Google the CPPIB Act, which is our governing legislation, which is actually quite interesting to read because there's a simplicity to it, but also a real clarity around what we need to do and what our role is. So very clear objectives: assist the Canada Pension Plan to meet its obligation, manage CPP investments in the best interest of contributors and beneficiaries like yourselves, and invest to achieve a maximum rate of return without undue risk of loss, having regard for the factors that affect the funding of the plan. Now that third piece, also referred to as our mandate, is it's an incredibly powerful tool because it gives us the flexibility to make the choices about how to best generate those returns to support the Canada Pension Plan. And I'm going to talk to you shortly about our portfolio, our investment strategies, our portfolio, and how that plays out. Now, again, in terms of the organization and its governance, I've sometimes heard stakeholders say to me, well, yeah, but couldn't one government decide that they want change your legislation to do something? And I can say, no. Actually, to amend the CPPIB Act, because this is an example of federal provincial sort of cooperation. In order to change it, legislation has to be introduced and passed by the Parliament of Canada. But 2/3 of provinces, with representing 2/3 of the population, have to support those changes. So the extension of the expansion of the Canada Pension Plan a few years ago, wasn't just the Canadian government saying, "Oh, we want to do this." They had to sit down and ensure they had the cooperation 2/3 of the provinces with 2/3 of the population. So that's quite a powerful amending formula, and it gives us a certainty and a structure that supports us in terms of how we manage your money. Now, moving on to investment strategy I'm going to start moving to slide 20, which you should be seeing a lovely little pie chart there with some blue and some green to talk about. And so I mentioned that in 2006 we made a change in the way we invest. Now, prior to this, when the fund had been created, they held basically fixed income, and then they sort of passively invested in markets. And some of you may be very familiar with this sort of strategy where you can buy an index fund and just sort of at very low cost and just take the market as it kind of comes and earn a return that way. And the lower cost structure can be a tremendous advantage going forward. And a lot of people choose to invest this way, and we did till about 2006. But at that point, particularly the board and the architects of overs and our stewards all took a look at whether there was an argument for moving to active management. And they discovered that they thought at that point there was that we could earn better returns than we would by just investing passively in markets over time due to a number of advantages. Now, the first set of these is what we call our structural advantages. So these are just advantages of that you have without just based of structure of the plan. It's like sort of being born 6 feet tall. You're going to be able to reach up to that shelf. So with active management, the main ones are size and scale of the fund, the certainty of the assets that we have, and our long-term view. And just one advantage of that, for example, is that we are able to buy assets and hold them for significantly longer than other investors might want or be able to. For example, some private equity funds manage what's perceived to be a long time, 5 to 7 years. But we literally have the capacity, if we have an asset that we think is good and a growth prospects and has a good place in our portfolio, we can hold that for decades. And likewise, when markets are volatile, and we've seen so much more recently within the last months, within the last 2 years with the pandemic, over the last 20 years with things like the global financial crisis, markets can be incredibly volatile, but we as an investor have that capacity to take the long view and often moved in sometimes to take advantage of opportunities that are presented within volatile markets. So those are structural advantages. We also have what we call our developed advantages. And among the very key ones is internal expertise. So where we have decided to sort of, retain talent and do things ourselves with in-house, for example, investing in infrastructure is a key part there. We have the opportunity to go out and hire excellent talent, and then sort of directly develop that and use that talent to access investment opportunities. Another one is smart partnering, where we sometimes choose to do things ourselves, invest directly. Other times we choose to partner with other organizations, and that can take many forms, either going in on deals with them or sometimes placing funds with them when we think they have the ability to deliver the returns that we need in a market leading way. And finally is our total portfolio approach, which allows us to sort of take a look at holistically at all $550 billion and decide the most effective and appropriate way in which to manage that. Now, moving ahead to slide 21, we now have a pretty significant global presence. Again, we're headquartered in Toronto, but if we look around which is where most of our employees are, more than 1,400, but we actually have offices open around the world. I think there's a little competition internally to say who was first. Was Hong Kong or London the international office? They've opened very close to the same time, and we also have offices in other jurisdictions where we think it's brings advantage to the fund. Most recently, we opened a San Francisco office. And what we found, again, a combination of things, we find that having these offices open and on the ground gives us two things, well, just many things, but two primary things are the ability to see and source good investment opportunities. When you're on the ground, you can sort of see, understand the market, understand what is coming up and what is there. And then for the assets that we have, these offices can also be very important in terms of our stewardship and ownership of these assets. We often buy businesses, assets that we hold for many years, so we want to ensure that we have a good line of sight on them, that they're good oversight and governance and well run. So again, these network of international offices is a tremendous advantage for us, helps us better to invest on your behalf. Looking at slide 22, we're fairly diversified. If you look at diversification by asset class, interestingly, the biggest asset class you'll see here is private equities. And many people understand that companies like pension funds invest in the stock market, which we do. We invest 28% of the fund in public equities. But private equities historically are a space where they can be less liquid, but they can also be a place where there's a higher premium because of that reduced liquidity. You can't turn around and sell a business the way you can turn around and sell a share of a company on the stock market. But historically, there's been a bit of a premium there. So that's been an area where we think there's been good opportunity, and we've invested significantly there. And again, that takes advantage of one of our sort of inherent advantages of that line of sight and certainty of assets in order as we seek to maximize returns without undue risk. Other asset classes, many people understand investment in bonds, which we do. We also invest in credit for companies, for businesses, and then also what we call real assets, things like infrastructure, ports, toll highways, that sort of thing, and real estate. So now, looking at slide 23, just to also give a sense of the diversification by region, again, we're quite significantly diversified. Our largest single market is the United States with 30%, 6% of assets. But we're invest around the world in markets where we think there's good opportunities. In Canada, we have about 15% of the fund in Canada. Now, some people, that surprises folks a bit, and they think, oh, well, if you're the Canada Pension Plan, wouldn't you be investing more in Canada? However, there's a tremendous diversification benefit investing internationally and having a bigger investable universe in which to seek returns. Also, the Canada Pension Plan itself, I mean, it's impacted by a number of factors, including Canadian economic growth and these sorts of things. If ever hypothetically you had a quote unquote made in Canada issue that impeded, let's say, the economy, that would also hit, if we were invested entirely here, that would hit returns as well. So that diversification has a real benefit. Now, that being said, it's interesting because Canada, if you looked at it from the other way and said, okay, well, you invest based on the investable universe, Canada only makes up something between 1% to 3% of, sort of global financial markets, global financial assets, whereas we're invested at 15%. So we're many times invested relative to what, the size of Canada. However, this is our home market. We know it well. We have people here. We have access to great opportunities. So we're very, very, comfortable with the level that we're at. So. And then moving on, slide 24, again, we have over 25 investment strategies, 6 departments, and I've talked about some of these, and again, things like credit investments where we have the opportunity to lend directly to, provide debt to businesses as well as sort of buying equity. We have the private equity space, and also things like, again, those real assets, infrastructure, real estate, things we own include, we're one of the biggest port operators, owners of one of the biggest ports, operators in both the United States and the UK, toll highways in many jurisdictions. So those real assets provide important diversification, a good source of returns. Yep. Going to slide 25. Now the question is sort of, asked, how do you decide, how to invest, how much to put in equities versus debt, this sort of thing. Well, we basically, again, take into account the needs of the plan. And now, when the Canada pension plan was expanded, we have one portfolio, but we sort of, it kind of has two pieces and two reference portfolios. The reference portfolio is the level of risk we're sort of looking at, and it also represents the road not taken, importantly. So if we look at the base, with so the original CPP before expansion, that part of the plan, we invest about 85% in equity equivalent, and then 15% in fixed income. Whereas additional CPP, which was designed to be focused more on all of the returns come from all of what the benefits ultimately flow from the returns generated from the assets. The decision was made there to take a lower level of risk on it, so 55% equities and 45% fixed income. And coming up on the half hour mark, going to go to just talk about performance, which is absolutely critical, as we all know when we sit down and look at our retirement statements when they come in. So the performance over the last 10 years, and again, we really, we report quarterly, but we often encourage people to look at our long-term returns because that is a key mark of sustainability. So the fund has grown as of the end of the calendar year to 550.4 billion. Our 10-year net nominal return after all costs is 11.6%. Now that's and now interestingly, somebody we were talking to about this was discussing how, well, yes, but you've had markets rise quite well. Have you really done that well? And we're able to answer positively because we have the reference portfolio I referred to, we use as our benchmark. So basically we look to see, since the start of, if we just invested passively, if we never gone into active management, if we just had the structure we had before 2006, where would the fund be now? Well, if you look at our annual report, I'd encourage you to look at a figure in there called compounded DVA. And that's the amount of basically the size of the amount added to the fund as a result of that active management. And as of the end of our last fiscal year, it was 28.4 billion. So in other words, the fund is 28.4 billion dollars bigger than it would be if we hadn't implemented active management. So and then just moving through, we report quarterly results of both base and additional CPP. And another figure, slide 29, sort of, again, in terms of how we're doing, this is a publication called Global SWF, which looked at, independent national pension funds like ourselves, as well as sovereign wealth funds, and looked at the returns of CPP investments over 5 years and showed us, to be in a leading position there. So again, we've been able to deliver those returns to Canadians, which or to the plan, which ultimately flow through to benefit contributors and beneficiaries. I'm mindful I've gone a little bit 1 minute over, so I'm going to turn it over for questions. And Annalise, I will be reading those to me as you present them and type them in.
Wonderful. Thank you so much for your very thought-provoking presentation. Actually, I must say I was guilty of one of those beliefs that you mentioned. There's lots of questions coming into the queue, so I'm
Okay.
gonna start.
I'm going to grab a glass of water. Yeah.
Yeah, I'm gonna start right away with Henny Mandel. Are
Mhm.
are our Canadian Northern territories not involved in CPP at all?
We Yes, they are actually. I wish my head of government relations, who I do the presentation with, sometimes were here. But I believe, yes, I believe workers in the territories, yeah, would be paying into Canada Pension Plan as well. Now they don't have that stewardship role that the provinces would due to the different status. But yes, they do. So workers there would pay into the Canada Pension Plan and would receive benefits in line with as other Canadians do. And in fact, we recently, it was 2 years ago, it was one of the last trips I did before the unfortunate events of the pandemic. When our chief executive, we went to the Yukon, and it was the first time that we traveled up there, and we met with stakeholders, business groups, residents, because they are part of the Canada Pension Plan, and therefore had an interest in knowing what we're doing, asking questions, all of that. Yeah.
Our next question comes from Knut Peterson.
Mhm.
Many thanks, Jeff, for speaking to SACPA. Alberta's present government are making noises, possibly replacing the CPP with a provincial pension plan. What
Mhm.
would what would need to be done for that to happen?
Mhm. All right. Well, this is an excellent question, and I can't go through all of the mechanics of it, but and I'd also would like to reiterate a few things. Just first of all, that as this idea has been talked about of whether provinces coming out of the Canada Pension Plan, that there's that potential because again, the Canada Pension Plan is under the Constitution. Pensions are provincial responsibilities. So a province has an opportunity, in the Canada Pension Plan has the capacity to do that. And we as an organization, I just want to reiterate, while we work with and we serve, all 10 governments, we are a very nonpartisan organization. And it's very interesting, as you can you also appreciate this, that all of the governments that we serve, we serve governments across the political stripe. So we're very much focused on our mandate and delivering those returns. But yes, we would, so this is a question that's sort of been raised, and that's for the people of Alberta, to decide. What we would flag a few things. One is, when we talk to Albertans and Canadians from every province of the plan, we talk about the benefits that we provide via, the experience of this organization and what we've been able to develop over 20 years. And also, one of the advantages of the existing plan is that, we have the pooling of risk that comes from the existing plan where, for example, Quebec, when it initially set up its own plan, there was a situation in which its demographics were actually younger than the rest of Canada at that point. Larger families, younger families, but the demographics have actually shifted in Quebec. So you now have a situation in which Quebecers would receive the same benefits as the Canada Pension Plan, but they have to pay a higher premium because the demographics change. So there's that benefit, but in terms of the mechanics of relieving the plan, no, it would be very complex, a lot of complexity and a lot of things because this wasn't in not every sort of piece of it would be envisioned when this was originally set up. And again, you'd have a situation where was Quebec set up their own plan from the very start, unwinding questions like, some Canadians, worked in Alberta and then moved to Saskatchewan, or some Saskatchewanians worked their whole lives in Saskatchewan and moved to Alberta. Questions like that would have to be addressed. There's a lot of complexity there. So I leave it to others to sort of maybe speak to the elements of that. I would just simply state that we very much, Albertans should also understand that the Canada Pension Plan, it is their plan. They are, as a province, it's not a federal plan, but it's a provincial federal model. And I sort of talk about the DNA of Western. I'm Saskatchewanian in this organization. Actually, just through this wall, the person working next to me is originally from Calgary. My boss is originally from Calgary, so we're very much integrated and part of and the lives of Albertans. So we also want to reiterate that as make them understand our role. Yeah.
The next question is on a similar topic. Ian
Hmm.
Hurdle. If Alberta manages to form a separate provincial fund, what
Hmm.
would what will be the downside or the downsides for the province and the rest of the country, especially if they are not completely at arm's length?
Mm, okay. Well, again, I can speak to, the advantages that we have. We're talking about a hypothetical situation where what exactly the structure and such could play out. That would all have to be figured out. But we, given that arm's length relationship with what people have with the Canada Pension Plan Investment Board, again, we've got a situation where because of our original structure, and then also the fact that you have the federal government couldn't change it without the provinces couldn't change it without the federal government. You have to sort of check on, we set up, we're at arm's length, so the mission to manage on behalf of Canadians, is very clear. Our investment mandate is very clear. And I also think of this story once in my journalism career where I previously worked. One of the places was Thomson Reuters Corporation, and Roy Thompson, who was a Canadian, entrepreneur who ended up owning the Times of London. He had, this. This little trick he did because he owned the Times. Many people would sort of come to him, influential, powerful people, to say, "Oh, the Times is investigating this or that. Could you just help me out as a publisher and do this about this story or that story. And he always carried a little something in his wallet, which was basically said, a card that said, as publisher, I don't interfere in editorial decisions. So sorry, you'll have to go, talk to the paper, talk to the editors, that sort of thing. And we've got that level of protection with CPP Investments and the Canada Pension Plan because of that arm's length relationships, because governments know that that board is there. Canadians can rest assured that it will be developed. The money will be managed on their behalf. Based on the criteria set out in our legislation. So that's the benefit. And again, talking about some of the elements I've touched on. Again, that element of risk, demographics. It's always understanding that by pooling the risk, there's an advantage in terms of if demographics ever shift. You don't have that you're not as susceptible to having to sort of change as a result if they ever go negatively in your favor or negatively as an individual jurisdiction. Yeah.
Our next question comes from Mark Goodall.
Mhm.
I contributed to both
Mhm.
QPP and CPP, and
Mhm.
I'm currently receiving CPP. Is QPP contributing to my CPP?
An excellent question. I will be fine to say I don't have I can't 100% explain the mechanics of that, but the way that CPP and QPP were set up was to have an agreement for portability. So that's again that one of the advantages that the existing plan is. If you're in Saskatchewan or Alberta or Ontario, you can move to any other province. Um, there was an agreement that had to be struck at the beginning to ensure sort of portability of benefits. In terms of how that is netted out at the national level for someone who paid into QPP retiring in Canada or vice versa, I'm not 100% sure on the mechanics, but there was an agreement that had to be set up to sort of ensure that level of portability of benefits.
Leona Jacobs,
Hmm.
to to what extent does ECG, and then in brackets formerly known as SRI, inform your CPP investment strategies? How clean environmentally, socially, and in governance is the CPP portfolio?
Okay, excellent question. And I think one thing that she's talking about there is ESG, which is environmental, social, and governance factors. So things like dealing with addressing climate change or human rights or the way that an organization, way its board is constructed. I would highly encourage, and this is a bit of a plug, and I have a bias here, which I should share, which is when I joined the organization, part of my role was to produce our annual report on sustainable investing. And I'd encourage everybody who's interested in this to go to our website and find the sustainable investing section. And there's again the annual report there that explains how we integrate ESG factors into our investing. Now, a thing to understand is that when people talk about environmental social governance, there can be different approaches of how you do it. It's like we only invest in these assets that meet this sort of criteria, might maybe at the exclusion of many others. With CPP investments, ESG is basically integrated into our investment process because we believe, and what we've seen is that companies that do better on ESG factors, it becomes important in terms of preserving and creating investment value over the long term. In other words, the companies are sort of getting these things right over time. It's absolutely critical. So we look at things through an ESG lens to ensure that, for example, if you're going to buy an asset, if there are challenges around, for example, ESG factors that need to be rectified and there's risks related to that, we have to ensure that's reflected in the price. And likewise, we engage with companies and we use our voting power where we see issues where we think that companies can better be advanced on ESG. We don't divest. We don't screen out companies in that regard. What we do is we look to see if there's an opportunity to engage. If we see that and there's an impairment to value or risk there, we have that option of selling on that basis. But we think it's very important. And when I joined, I confess, while I had written about and knew a bit about the organization, I hadn't appreciated the degree to which we have a sustainable investing team as well that you can read about on the website and in the report. And again, these are individuals who are working with all of our investment professionals to better understand all of these factors, how they impact things, how we can engage with companies to improve these factors, and be a voice, a positive, constructive voice in that regard, within the context, and again, the important goal of protecting value and generating value for Canadians for the long term.
Okay, Laurie Schultz. Arguably, lower birth rates impacted the 6.5 employees,
Mm-hmm.
would have allowed more women to enter the workforce, contributing
Mm-hmm.
to CPP.
Mm-hmm.
Curious if this factor was taken into account in your analysis.
Okay, excellent. Actually, I have to give credit where credit is due for that analysis. That is the analysis done by the Office of the Chief Actuary. And again, we work very closely with that office because, every 3 years they do that deep assessment on us. So they have to understand what we're doing, our approach, that sort of thing. But it is the Office of the Chief Actuary itself that is baking in those figures, and sort of talking to them. When I first had the opportunity to learn more and actually meet the Chief Actuary and see what the work they do, it is very impressive and it's very extensive. So it's taking into account, it's taking into account birth rates. It's taking into account, women in the workforce, number of Canadian workers in the workforce, projected economic growth. Again, immigration affecting things, how increasing lifespans are playing out. All of these pieces are taken into their very deep sort of analytical study of the sustainability. So as things have sort of moved along, and if things ever changed, if birth rate changed, or there were more immigration of younger people, this sort of thing, that triennial review would take into account these new factors every time, and it does. Yeah.
Our next question comes from Ian Hurdle. With political and financial rule changes in Hong Kong, will this cause an office move to a different Southeast Asian base?
Okay. Well, excellent. Noted that we have a Hong Kong office. Well, I can't speak, and just generally, I'll speak to make clear to folks. I'm usually here to speak forward on things that have happened and where we sit, and sort of a structure of things. I can't speak to any specifics around where we would invest, for example, or that kind of thing, or maybe a decision of this point. But I'll simply put out there that we look at, in terms of locating our offices, we make assessments on again where that benefit is to Canadians, and in terms of the ability and the line of sight and the opportunity it gives us in terms of investments and such, and also that that we are constantly evaluating, and again situations, and going back to the question about demographics, these situations always change. They're always dynamic. There's always a flow. So what the political situation was 3 years ago, can be different 3 years from now, or what the demographics are, that sort of thing. So we're continually reviewing and assessing, and we do that in terms of also the every market that we invest in, we make assessments about what is the political and geopolitical sort of structure and environment in which we're operating, and what does that mean for the risks involved, potential returns as well, all of that piece. So we're continually assessing events as they happen. Yeah.
Leona Jacobs, to what extent are CPP investments informed by federal government initiatives? For example, the federal climate action plan to reach net zero. Are
Mhm.
such are such government initiatives considered?
Mm. Okay. Well, I'll put it out there that initiatives of the federal government or provincial governments, or the governments of any jurisdictions which we invest, we are looking at them from an investment perspective. For example, we might, one country might have a policy around this sort of initiative about levels of taxation, whereas a second country may have a different approach to taxation. What we're coming at the perspective of is, because again we operate, our mandate is very clear. We don't take into account the directives. It is about maximizing return without undue risk, taking into account the needs of the plan. However, to be a successful investor, what you have to do is understand the policy environment of all the different jurisdictions that you're operating in. So what the Canadian government might be doing, or the Alberta government, or the U.S. government, or the pick a government, the Italian government, the policy environment that they're kind of creating into place, we are looking to manage our portfolio in that context and understanding what the implications are going to be. So in that that sense, we're always studying what all governments are doing and how it will affect, the existing investments we may do. But in terms of the government being able to sort of set that level of policy, we have that arm's length relationship where we can. We have that sort of written into our structure that allows us gives us that distance. But we pay tremendous attention because government decisions at all levels in all jurisdictions have long-term investment implications.
Our next question comes from Beth Mundell. With so
Mhm.
many people working part time or in the gig economy, for them, the underlying assumption of a quarter to a third of their pension doesn't work.
Mhm.
So, if is this being taken into account and allowing gig part-time workers to contribute more and then receive more when they retire?
Mhm. Okay. Well, I will say that again, as the demographics of the funds are being taken into account, or all of the factors, including the size of the workforce, part-time versus full-time, all that sort of thing. That would be a consideration for being looked at that structure. But I will say, in terms of a policy decision, the expansion of the Canada Pension Plan, I know that one of the arguments made was that because if you were maybe I had the at one point worked for a company for more than 20 years and eventually changed employer. And I remember at the time, some of my friends who'd worked more in that gig or contract type economy were, said you're a bit of an outlier. 50, 60 years ago, people would work for an organization for 20 years and have that pension and that level of support. So I think when governments were deciding to expand the CPP to go more, go larger, part of the consideration was that that there are fewer Canadians, I think, who would be covered by, say, a defined benefit pension. So that had to be a consideration. So the decision was made that they would, have the opportunity to pay more, or that they would be paying more into the Canada Pension Plan as a result, getting more of that because, if you are a CPP contributor, and that can be for self-employment as well, where you'd have to pay both halves, well, both pieces. But it doesn't matter if you have one employee for 20 years or 20 employees for 20 years. Depends on ultimately the level of income and the contribution rate that you would have. But that the CPP, one of the benefits of it is that it follows you everywhere, so to speak. So that was again a consideration and design of the plan. But in terms of our we don't again the design of that plan is left to policymakers. That decision was them. In terms of us advocating for larger or smaller, what we simply did at the time was we were asked the important question: is if the Canada Pension Plan was expanded, do you have the capacity to invest more on the behalf of the fund were to grow? And we did the assessment, and so we were able to go back and say yes, this would be the plan and the structure and how we would go about it. But that is a decision that ultimately sits with the policymakers.
Our next question comes from Knut Peterson. With the possibility of a future guaranteed annual income being implemented in Canada, how may that interact with CPP?
Okay, a very interesting question. I would have to, it's a some way speculative question because I know it's an idea that's talked about, the idea of a basic income or universal basic income. Um, but that is very speculative, and I don't know of any government that's quite pursuing it. I will share a little something that might be a bit of an illustrative example because I again also sometimes talk about this with family and the idea that people talk, oh well, there's what if we created this basic income, and I point out actually there is a basic income. To it, it's not universal by any means, but actually if you look at old age security and that GIS, the guaranteed income supplement, that is actually effectively a kind of a basic income because if you were, let's say you were somebody who were you were ill your whole life and you were never able to work and save, when you turned 65 or young, I think you could apply when you're younger for a reduced amount, but let's say at 65 you could apply for old age security and you would receive it irregardless of that. So it's a kind of a basic income in a way if you think about it. It's not what it's called, and I may be stirring a little bit of debate here, but I give the example. But if you look at old age security, how does that interact with Canada Pension Plan? Well, again, Canada Pension Plan depends entirely upon how much you contributed, and over how many years. So if you manage to work the full 40 years at a full rate, you're going to get the full amount. If you worked 20 years at the full rate, you get half of that. So it's always tinged to that. But what it is it's combined, with CPP and old age security. A couple things to consider. Canada Pension Plan is taxable. So if you move into retirement, you have a lower income, and you're going to pay a lower income tax, you'll get to keep most of your Canada Pension Plan. If you were, have a higher income in retirement, that would be the CPP payments are subject to taxation. There's the interaction there with old age security where past, I believe, past a certain level, they begin to claw it back up to, sort of as you escalate, something I've heard about from retirees. And I'm wondering if there might be a bit of an illustrative example there. But so I think we have a kind of a old age security pulling in a bit of a role of basic income for seniors. So the question is, it might be interesting to sort of illustrative to look at how that interplays with CPP.
Our next question comes from Bev Mundell. How are investments protected against global factors like war, inflation, pandemic, stock market crashes, political issues, etc.?
Mm-hmm. Okay, great question. And just to put it out there, frankly, when you invest, there's a trade-off between like risks and returns and sort of working your way up the sort of spectrum. We could, for example, buy a Government of Canada 30-year bond or put everything into Government of Canada bonds, and there's that safety and security of principal, or well, depending on if you buy them on market rates, or if like a GIC type example, but when you as an individual go to invest in a GIC, there is you get a security, but you receive a slower return. You're not going to lose your principal, but you do get a situation in which your upside is limited. Whereas if you choose to invest in financial markets, wider assets, equities, real assets, you have the potential to earn the higher return. However, there is the greater risk that comes with all of that. So I'd say a couple of things about how levels of protection though in there. I think the main one and the most powerful one, and I was sort of learning about economics when I was younger. This phrase always stuck with me. It was I forget the name of the Nobel Prize winning economist who sort of studied investment and investing, and they said basically the only free lunch in investing is diversification. So I took you through the slides of how we invest very broadly, both in terms of asset classes, but also geographies. So again, we get a situation where you might have an issue in one geography. However, let's say it was Canada. There was something that would happen here that would hit all of the 15% of the portfolio that is in Canada. However, the fact that we have those assets in other jurisdictions, that's a level of protection that comes with that. Another thing, an example would be inflation. Well, inflation is very negative for fixed income returns. It eats into, real returns. However, oftentimes infrastructure can form, or real assets, real estate can be a hedge against inflation because, for example, you might have inflation in a jurisdiction, but you might be able to raise rents consequently as a result of that. Or sometimes equities can perform well if you own equities that are, in consumer goods companies that are able to raise their prices, this sort of thing. So that level of diversification. And then in terms of the organization for our actively managed portfolio, we're constantly looking at these risks and constantly assessing. And we have a chief investment officer, a chief investment strategist. We have individual investment teams. And whenever we're buying, we're doing this investing, we're doing it through the lens of what is the risk return here, and doing our best to assess all risks, including our department that I'm in is involved in the assessment of political risks and sort of the geopolitical sort of factors unfolding. So again, I would say it's a combination of things, but diversification is very important, both in terms of geography and assets, and then that rigorous sort of assessment of risk-adjusted returns whenever we're doing investments. It's a key part of sort of active management.
Our next question comes from Mark Goodall. Are details of the portfolio available to the public other than asset classes?
Yes, another opportunity for me to encourage you to go onto our website, and you can actually see in terms of our holdings, we give pretty significant. You'll look into if you go onto the website, you'll find that we disclose our portfolio holdings once a year. So you will see as
Well, folks, Skype just dropped us. I'm sorry to say. I'm trying to reconnect with Jeffrey. Hopefully, he will join us shortly. But it looks like Skype just got dropped. Bear with me for a few minutes and we'll see if we can get Jeffrey back.
Elise,
Yes,
so sorry.
yes, yeah.
Okay, apologies. We had a very good 56 minutes there without technical issues. That was my fault. I basically will not do that again, but I tried to go to our website to find the exact spot. But if you go to cppinvestments.ca, .com, you will find a list of our portfolio holdings there. And again, once a year. Now we can't disclose it live in real time. There are, investment and commercial considerations about why we wouldn't want to do that. But I encourage you to go on and have a look at what we're able to disclose publicly.
Excellent. Thank you. So that was Mark Goodles. We have um, a last question from Knut Peterson. Approximately at what age have most pensioners received back what they or slash their employers paid in? And if they pass away very early, should the payout be indexed?
Okay. Yes. Now that's a question I'm going to put out there. I'll share a personal experience on this because in terms of my own family, one of my parents was getting ready to sort of take her CPP, and we were discussing it, and I was saying that and the important thing is to potentially to talk to a financial advisor because you have to. I think it depends on sort of individual circumstances, this sort of thing, but talking about some of the bigger factors at play. If my understanding is, and a financial advisor can sort of tell you exactly where, and in the specific circumstances, they had done some calculations and said, oh, it was approximately, if my parent were to live past the age of 82, they would be better off, they would be sort of the further ahead, at that point in deferring a pension and sort of receiving better benefits. Because I get these questions and I have to send people back to their financial advisors because they're like, what age should I take my pension? And what would your advice be there? And I'm like, we manage the money. We don't offer financial advice, but some of the considerations at play are, one, do you need the money? Maybe some people need it at an earlier age than others. So a financial advisor, or if you're assessing your own portfolio, you have to ask yourself that question. But another question, which unfortunately unfortunately we can't answer, but we don't know exactly how long each of us is going to live. And if we could go to our financial advisors and say, we're going to live at this, exactly to this point, when do I take my CPP? We could do that. Now, in this situation, I pointed out to my parent that their own parents had lived well into their 90s. Mother had lived into the 90s, father was over 100, so it would make sense probably to defer and wait and this sort of thing, because as long as they could live past, I think it was early 80s, they would benefit from that. And then my advice wasn't regarded at that point, and that's so it goes. But so again, on this one, I'd really encourage people. To sort of they have to know their individual situations, and if they are able to get some assistance with somebody who can help them with their planning, looking at their existing assets, their personal situation, that would be the best route.
For a final question, I missed it in the queue. My apologies, Laurie. With respect to portability of CPP between provinces, if Alberta was to exit from CPP, would you anticipate that an Albertan CPP would continue were they to move from Alberta?
Well, again, that would all have to be. I think there's a component of things that if there were something like this were to happen, there'd have to be an agreement worked out. There'd have to be, but of some kind. But the nature of it, again, it is, you're looking at a tightly interwoven. Talking about people moving between jurisdictions. I mean, there's incredible complexity that would sort of come about as part of this. So I hesitate to sort of speak to that because, again, the level of complexity involved in all of the considerations, I can't get into the depths of that. That just people would have to understand that this would be an unprecedented thing with Quebec. They started out on their own, and it was sort of set out on their own things. So that challenge of sorting everything out, when when you do something like that, people have to take into account also the costs and all of the dynamics that the interplay there, and complexity can be a challenge. Yeah.
Okay, well, that's it for the questions. There's a lot of thank yous. Wow, lots of great information. Thank you so much for your great talk. Excellent information. I really enjoyed your presentation. So there's lots of thank yous out there in the queue. On behalf of SACPA, thank you so much for your time, Jeffrey. Before we wrap up this session, however, do you have a take-home message for our viewers?
I think my main take-home message would be to encourage maybe a couple, if you allow me. One is I haven't been able to answer all of your questions here and this sort of thing, particularly about the organization, but we have great resources. Our website, CPP Investments. Go and take a look. You'll find all sorts of information there about great videos and structures in about how we operate, what our focus is. So I think that would be useful. And maybe another takeaway: remember when you hear that younger niece or nephew in their 20s at the barbecue or whatever saying, "I'll never get CPP." Remind them, tell them about the Office of the Chief Actuary, the assessment, and say you may have many things to worry about in your life, but maybe this is one you should be worrying about less than you are now, and so freeing you up to focus on other things. So those would be probably my two main takeaways.
Excellent. Thanks very much. And to our viewers, we hope that you'll join us again next week with Bob Ashka. Can AMCO be fixed or saved? Are 500,000 Albertans and their families in jeopardy with AMCO? I hope you'll join us then, and have a good week, everybody. Thank you very much.